Welcome to this call where we have a speaker and presenter today in Cameron Bagrie. For those of you that don't know me, I'm Matthew Nower. I'm the General Manager of Distribution for Vega, and I will be hosting the call today with Cameron. A special welcome to all of those that have come on the call. I can see the numbers are quite high, so we have a special welcome to our key partnerships across Bailey's, Rothbury's, some of our key suppliers, other financial advisors, influencers, and obviously those customers that were invited to join the call today. Thank you for coming along, we appreciate it. So without further ado, I'd like to introduce Cameron. Cameron had 11 years as the former chief economist with the ANZ. Prior to that, was with the National Bank, Treasury and Statistics New Zealand. He also runs Cameron Bagrie Economics, which helps businesses across New Zealand navigate the economic minefield that we find ourselves in, both current and forecasting. He brings a pragmatic approach to economics and a non-ideological approach as well. So hope you walk away from this more informed than you did when you came in, and we look forward to hearing from Cameron. So without further ado, welcome Cameron.
Thanks, Matthew, and we'll kick into it. Look, I'm going to take people through in this presentation just some bigger picture themes. Yeah, obviously key topics such as inflation, interest rates, impact of higher interest rates on housing. But before we sort of kick off with that, look, we're getting it straight into the obvious in regard to COVID and Delta. Do we have an awful lot of clarity at the moment in regard to when Auckland will potentially go to alert level 3? The short answer is no. The case counts for the last couple of days, I'd reflect partially lower testing. The next 3 days, I think, are going to be pretty critical in regard to shaping how quickly Auckland can go down to alert level 3 and then potentially level 2. But one of the things, the Reserve Bank put some commentary on Delta and COVID within their August monetary policy statement, and it wasn't really picked up. But here's the basic guts. Like if you think about your wealth, people tend to think about your wealth as being where you sit today. But if you think about your spending attitudes of today, they're not just off current wealth, they're off your perceptions of wealth, what you're going to be making down the future. You think about a discounted cash flow model in regard to how you value a business. Well, spending for society is no different. And I guess pre-Delta, pre-COVID, we had an awful lot of clarity that, broadly speaking, the global economy in New Zealand was going to be a pretty good place for the next sort of 10 to 20 years. One of the things that no one's talking about in regard to COVID is that what if this is a major shock that persists for an extended period? And what does that mean in regard to what's called the productive capacity of the economy? And the productive capacity of the economy, just a fancy word for how fast the economy can grow. Maybe we can't grow as fast as what we're used to. What does that mean? Wealth creation, incomes are not going to grow as fast. Now, if you think that through its logical conclusion, then the logical conclusion is that we might not be as wealthy as what we all thought we possibly are. Now, there's a long way to run in this sort of stuff, but we're going to have a pretty clear debate, I think, and the sooner the better, on the trade-offs between public health, economic outcomes, and mobility. And because it's pretty damn clear, elimination is not going to work. If we stamp it out this time around, odds are it's going to come back. And some of the models we're looking at around the globe in regard to where we're likely to be is places such as Singapore. But what we know in New Zealand at the moment is that we're running a really risk-averse strategy. The government, obviously because vaccine rollout has been, I won't say terrible, but it's certainly been poor. They're still putting a pretty high barrier on, i.e. the percentage of vaccinations we need to have in New Zealand before the government of the day will even entertain the idea of not rolling lockdowns. But we're going to have that discussion going forward because the economy cannot continue to have those economic punches that lockdowns repeatedly are throwing out. I'm looking at what we call the holy grail. And what we got at the moment is a real big complex combination of shocks. If you think about shock one is COVID, shock two is the rewiring of the New Zealand economy in regard to climate change. And that's going to have some real economic impact on the productive capacity of farming going forward. And I'll give you a heads up, New Zealand's still one big farm. We're about a $30–35 billion net export of food. And that sector faces real challenges going forward in regard to facing up to meeting environmental challenges. Another shock is obviously housing. It's now on the gun sights of the Reserve Bank on multiple levels, macroprudential policy, potentially some sort of debt servicing restriction coming in, interest rates moving up, but it's also on the gun side of the government of the day, because I'll show you a chart in a second. Housing is the big issue of the day. And we've also seen another shock, and another shock is rebalancing the economic pie. Yeah, this is the sort of shift towards, I guess, an extreme form of capitalism, towards a more worker-friendly or long-term manifestation, which is what we call stakeholder capitalism, which is really talking about the long game in expense of the short game. But if you go back and have a look at the past 30 years, workers' wage bargaining power has been diminished. We've seen unions diminish in power. What we're now starting to see, and it's got a fair bit of muscle behind it, is that we're seeing a bit of a rising. And what that personifies is a little bit of, in fact, it's not just a little bit, it's a lot of redistribution away from capital towards, or the employers towards the employees or the workers. We talk about this within what's called respective shares of GDP. But what we're trying to find is, I guess, the holy grail. Now, if you go back, past few election cycles, what have we seen? To be perfectly honest, one side of the political fence focuses too much on the economy, and they don't focus enough on the social side of the ledger. And now what we're seeing is that the other side of the political fence is now pretty well focused on the social side of the ledger and not so focused enough on the economic side. Now, I'll give you a little bit of economics 101. Welfare needs an economic base. And what we're trying to achieve, and we're not getting that balance right at the moment, is that ledger squaring between the two. I guess you could manifest it in regard to real centralist style politics. But ultimately, if you let the social ledger get disconnected within the economic side, then the social ledger will bite the economic side. And I'll give you an example. The example is, if housing is a big problem, then housing is not just a problem in regard to putting a roof over people's head. It becomes a problem in regard to kids attending and turning up at school. And if kids are not attending and turning up at school, then that's a major problem in regard to where the economy is going to be 20 to 30 years down the track, because education is a pretty big predictor, barometer of where we're likely to be. So, the holy grail is all about, can we get some more common sense or balance back into the equations, because the narrative just seems to swing from one side, from economics to the social side, and then we go back the other side and 180-degree flips. We need to see that balance between the two. Biggest issue out there across New Zealand at the moment is housing. I look at the Ipsos Issues Monitor as a bit of a sense check on the mood of the nation. Housing is a concern to 53% of New Zealanders. That is basically double the next biggest issue, which is healthcare, and inflation rounds out the top three. Interesting to see crime, law and order has now appeared in the top 7. I think that is telling us something about what we call the K-shaped cycle. Yes, there's been an awful lot of backslapping in regard to how good New Zealand has been for the past 12 months. Soaring property prices, asset prices in general have gone up. We've got the economy back on track. Out there across New Zealand at the moment, there is a very soft underbelly where an awful lot of people are still struggling, and that was prior to heading into lockdown. And what we're starting to see in areas such as Newmarket is that the crime is really rocketing. Now, that stuff, I think, is telling you something about how divided New Zealand is in regard to who's creamed most of those gains in the last 12 months. But housing as a top issue has basically forced or told the government to act. And some of the things we've seen from the government, such as the $3.8 billion infrastructure acceleration fund, is really good. An additional $300 million for Maori-based social housing, I think, was another good initiative. Some of the other stuff, to be quite honest, is an absolute farce. Kiwi Build, It needs torched. You know, what they did to landlords in March with the removal of that interest deduction was just absurd. Now that's just a reflection of, unfortunately, there is now a political overlay in this. And housing investors need to think very careful about the political risk in regard to housing, because so long as housing is the top issue across the Ipsos issues monitor, it'll probably get popped off this quarter because of lockdown, but I suspect next year it'll be back top of the pops. You know, it's been the top issue for households for 11 of the past 14 Ipsos issues monitors, and it's telling us a real underlying story. The Reserve Bank was pretty stern on what they said, both within the May Financial Stability Report, also the August Monetary Policy Statement, and then Adrian Orr turned up at the Financial and Expenditure Committee, and he told the committee point blank, house prices are unsustainable. Now, that does not mean house prices move backwards, but they certainly need to step down a gear. And what also came through within the August Monetary Policy Statement was that they're a lot more confident that they're going to see the property market moving in that sort of direction. As they pointed out, there's been a big fundamental shift between the big drivers, demand versus supply, i.e. supply is now turbocharged. If you look at building consents, they're up around 44,000 in the last 12 months, and underlying population growth with borders shut in New Zealand is about 35,000. But what the Reserve Bank, and they've been following through on this, and we're now starting to see the banks follow suit in regard to, they've obviously tightened up in regard to loan to value ratio restrictions. Debt servicing metrics will get tightened up as well. But there's a big, strong push on multiple levels to get the property market under control. Now, that still faces challenges, and I'll give you an example. You know, housing supply on a lot of levels is still what we call inelastic. It doesn't respond quickly, and one of the big drivers here is just the outright availability of land. If you look up in Auckland, section sales account for about 5% of total property sales. There's just not enough land out there, and we've still got that perennial problem that is going to be around our neck, I think, for an awful long time. Look, everybody can take a bow. We've got first world, first class problems in regard to what is really tickling people up at the moment. One is high house prices, and two, and I saw one of the bank economists came out and put a negative spin on unemployment rate being at 4%. Well, let's be honest, not finding staff is a problem for firms, but it is one hell of a nice problem to have. New Zealand's challenges at the moment is that heading into COVID is that we were navigating what's called success. The economy absolutely jumped ahead of expectations with the degree of pent-up demand, bounce back, that redirected spending from offshore tourism into local tourism. I've coined an economic phrase. I've repitched what's called the bucket list. I won't use the term on the line, but if you replace the B in bucket and put an F in it, you might get an idea about what the economic terminology is. And it's all about people just saying, God damn it, I'm going to get out there and do that thing. I can't take that overseas holiday. I'm going to buy that fancy house down in Queenstown. I want that new car. I want the RV. I'm going to get out there and I'm going to spend a little bit more money myself. But by the way, life's short, so I might dish a couple of 100,000 earlier to the kids so they can get on the property ladder. But that sort of effect has been really profound. What we're also seeing is non-performing loans across the banking sector are still incredibly low across all the segments. But of course, if you wander down Queen Street, or if you wander down the main street of Hamilton or Tauranga or other places around New Zealand, you'll get a completely different picture in regard to what's going on, because we're starting to see vacancy rates absolutely skyrocket. Now, that is just telling us about this polarized two-tiered economy in regard to what's going on. But in aggregate, the economic story heading into COVID was undoubtedly one of strength. One of the big things I am concerned about at the moment is pressure on working capital. Now, debt is one constraint on businesses, on households, but the critical thing for businesses is having the cash flow to open up. And at the moment, I think that cash flow pressure is really going to start to bite heading into the end of the year. And we've got to get Auckland opened up pretty quickly because, otherwise there's a real prospect. They might have 2.5 months of trading before everybody heads off for Christmas. And of course, there's not much invoicing that goes on in January next year. So we're in a bit of a critical period in regard to trying to get things open up. I'm keeping a really close eye on the property market, particularly Auckland. And I keep a track of Auckland's population growth relative to building consents. What we're seeing at the moment is the building consents are turbocharged. Obviously, townhouses, all these units getting erected. The estimates out there suggest Auckland's got a housing shortage of about 25,000 a year. By my calculation, I think that shortage is going to be eliminated in the first half of 2022. Now, other regions, I think it's going to take until the back half of 2022, maybe 2023, before that story flips. But there's been a big fundamental shift at the moment in regard to the balance between supply and demand. Caveat, the supply side disruptions that we are seeing in regard to getting both staff, but also just sourcing items across the building sector is potentially giving us another 3 to 6 months before that supply demand situation really flips. One of the things I keep a close eye on and I update regularly is what's called a traffic light system. The traffic light system is not about near-term economic momentum. It is all about how much muscle does the economy have? Are we structurally strong? Are we mediocre? Or do we not have much muscle about us? Way back pre-COVID, we had a few red lights, we had a few orange, and we had a few greens. Now, if I have a look at where we sit at the moment, we've still got a few greens, but we've got more reds. Inflation is more of a risk. Asset valuations are more of a risk. House prices, because they're up 30% in the last 12 months, it is now more of a risk. Now, those reds do not personify that things are going to turn immediately. But what they do say is that we're in an environment where we just need to acknowledge there's a lot more risk out there. So that Hill Street Blues motto of just be careful out there applies an awful lot more now. And this is outside of COVID-related challenges relative to what it did 12 months ago. Demand's the big issue. Go talk to any employer at the moment, and they're absolutely getting stuffed in regard to the availability of staff, but also the regularity by which staff actually turn up. Talk to orchardists, people that turn up to work, pick a bit of fruit in the moment, they'll be off by 1, 2 o'clock in the afternoon. And this is where people have underestimated the importance of the likes of the backpackers or just bringing in those migrants. New Zealand's had a labour market model that has been very reliant upon importing people from around the globe. And what's happened is that we've underinvested in training of local-based talent, and a lot of that really good local-based talent has been inclined to go to London or other parts around the globe. And I wonder about when borders start to open, whether we're going to see a bit of a rush in regard to that. But I find it quite horrific that we've got 350,000 people on a benefit and the Reserve Bank is telling us that we're at full employment. Now that is telling us something about structural issues that need to address. And it's pretty easy to get unemployment down into the 4% zone. What do? You cut interest rates and you spend an awful lot of money in the government. Now that removes what's called cyclical unemployment. What we're now left with is what's called structural or institutional unemployment. And the Reserve Bank noted in February that if structural constraints on Maori employment were resolved, New Zealand economy will be able to support a higher level of overall employment without generating inflation pressure. What that also means is that it means interest rates would be lower than what would otherwise be the case. Now, the Reserve Bank statement doesn't just apply to Maori, it applies across the board. And this is where we've been fixated with demand, but the building blocks of your economy, wealth creation, is actually all about supply. And what we're seeing at the moment, we don't have insufficient demand, we've got problems meeting that demand. And this is where the real hard mahi policy actually starts, because we've got to get stuck in and start to address some of those big structural issues. Ask those hard questions. What are some of those structural constraints on Maori employment? And I'll give you a heads up. If you have a look at the structure of the labour force over the next 20 to 30 years, a rising proportion of employees is going to come from Maori Pacifica kids, because that's where we're seeing the higher fertility rates. We're already seeing it through the school system. Yeah, so this stuff is really important in regard to where New Zealand is going to be down the track. On to inflation. Central banks out there at the moment are saying inflation is going to be transitory because of disruptions to global supply chains, higher shipping costs, etc., etc., etc. They think it's going to be temporary. It's going to settle down the second half of 2023. An implication of that view is that they don't need to be heavy-handed on interest rates. That at the moment is a really big call, because I have a look at what I'm seeing on the ground at the moment is that pricing intentions have absolutely skyrocketed, particularly across retailers. I'm not seeing cost increases coming through that are a function of supply chain disruptions. I'm seeing cost increases across the board, most notably in the labour market. Now, some of that is a function of you can't find staff, so you got to pay up both to attract them, but also to retain them. And there's a little bit of warfare that seems to be going on at the moment in regard to bidding up the price of people. But this is where things such as increasing the minimum wage, which is admirable and needed to be done, if you do it too quick, too fast, well, that's another big cost for small businesses. But what we are seeing out there at the moment is some real big structural shift to me that suggests the inflation pressure we are seeing might not just be temporary. Now, survey measures are telling me two stories. If I have a look at the Reserve Bank's what's called survey of inflation expectations, the left-hand chart, they're telling me everything's going to be okay 2 to 5 years out. There's been no material change in regard to how market participants view inflation, and for a central bank, that is really good news. If I have a look at household measures of inflation expectations, they're not telling me the same story. Household measures of inflation expectations have had a pretty clear ramping up in the past 6 months. Now, household inflation expectation measures have tended to be too high. They've overclocked actual inflation by a long way. But that jump up in the past 6 months is still pretty stark. What I also suspect is that it might not just be a proxy for inflation expectations. I think it's got a bit of a content about it, where households are viewing where wage settlements need to be over the coming 12 months. And here's some basic maths. Inflation at the moment, headline is 3.3. It looks like it's going to be 4 to 5%. The likes of the nurses were right to reject the government's pay offer. Inflation is what we call a bogey variable. It provides a bit of a reality check on that mismatch between demand and supply, but also getting the building blocks of your economy right. Inflation's a thief that steals savings, and if the cost of living's moving up, well, that's going to predominantly hit low-income families. And I'm not sure what everybody else is seeing out there at the moment, but I personally am seeing an awful lot of things that are moving up in price. And some of it's regular things such as your insurance bill, your rates, etc., etc., etc. But you go talk to any business at the moment, and they are just getting inundated with letters month after month in regard to the pricing of stuff that's going up. And this is not just going to hit households. I think it's going to hit the government in the pocket as well. They've got a pretty big personal expense bill. They pay an awful lot in welfare benefits. One that I'm watching closely is the cost of various infrastructure projects. So you think about Three Waters, it was priced mid-range estimate of 150 billion. I'd say that will now be closer to 200 billion. Now, this is not just new projects. This is projects that are already underway, where the costs are just going to be astronomical. So hopefully this could be a bit of a reality check in regard to getting the government thinking a little bit differently in regard to what they could potentially do to dampen some of that inflationary pressure out there. Because when you got inflationary pressure, the Reserve Bank, as they alluded to a couple of weeks ago, you no longer need interest rates at what's called emergency policy settings. And it's pretty obvious interest rates are going to move up, but you've got to put a long-term perspective here on what's going on. Interest rates have been the property market and asset prices friend for a really long time. The trend for 30 years has basically been interest rates plumbing lower and lower lows. And if interest rates plumb lower and lower lows, then asset prices basically plumb high and higher highs. And what we're now starting to see is a bit of a delicate turn in the interest rate cycle. And I look pretty closely at what's called compensation for risk. And barometers of compensation for risk is really the gap between the likes of residential property yields, cap rates, and what's called the risk-free rate. Now, the risk-free rate, you can use a 10-year bond, you can use a bank deposit rate, you can use the official cash rate, something like that. But what we know at the moment is that yields have continued to compress, particularly some cap rates that I've been seeing out there in the commercial arena. At a time, we've seen early signs that the interest rate cycle is turning. Now, the good news is that there's still a positive gap between yields versus the risk-free rate. But what we are starting to see in some pockets is that compensation for risk is getting pretty skinny and pretty narrow. And this is where we go back to the previous slides, looking really closely in regard to how inflationary expectations and inflation more broadly evolve, because the last thing asset prices need going forward is an interest rate shock. There's a central scenario that we get an interest rate shock. The answer is no, but it is a scenario where inflation becomes a little bit more persistent, that could become a little bit problematic, and you've got to always put some sort of probability on that sort of scenario. What we need to see across New Zealand at the moment is a combination of initiatives. The Reserve Bank has obviously ended the large-scale asset program. They will stop the funding for lending programs soon. Personally, I don't know why they bought it in the first place. The banks are not short of cash. They're absolutely swimming in it. They're obviously deploying macroprudential policy tools to slow the property market up, and they're going to lift interest rates. The market is still dead set. They're going to go in October. To me, it's not the 100% probability that the market is basically placing on it. And one of the reasons I say that is that as a central bank, you'd be absolutely nuts to be lifting interest rates if the likes of Auckland is still in a lockdown. Now, would that be the central scenario at the moment, that Auckland is still in a lockdown in early October? Maybe not at a 4, but certainly I think there's pretty decent odds that Auckland could still be at a 3 or a 2. What we'd like to see is what's called fiscal policy, or the government helping monetary policy. If the government can help monetary policy, there's going to be less pressure for interest rates to move up. And this is where we need to see government ease back on spending. Good luck with that. It's just not going to take place. There's going to be pressure for them to spend more, and that's been the experience for the past 3 to 4 years. We'd also like to start to see supply side initiatives. There's some of the stuff such as opening up the RSE workers for horticulture was really encouraging. It looked like they were starting to get the message. Now, obviously, all the attention is with Delta. So supply side initiatives, I think, have been parked for quite a while. Interest rates are going to move up. The first port of call for interest rates is what I call the neutral OCR, where the Reserve Bank's neither got the foot on the accelerator or the foot on the brake. It's around 2, about 175 basis points above the official cash rate at the moment. So if you think about where a 1-year fixed mortgage rate is likely to be in 24 sort of months, you're probably talking up somewhere around 4.5. Carded floating rate, somewhere up with a 6 in front of it. Now that will hurt some recent borrowers because, well, interest rates are still low. Obviously, the percentage increases carry a lot more punch when you're shifting interest rates stuff extreme lows. But this is where I hope that the bank's doing their jobs in regard to applying those mortgage serviceability test ratios, actually provide a bit of protection. Yes, we know the banks have been dropping those test ratios over the past couple of years, largely because they've been up to the play that the neutral interest rate is a bit lower, so your mortgage serviceability test can be a bit lower. But that gap between the 12-month fixed mortgage rate and potentially where I think the 12-month fixed mortgage rate is going to be still gives me a little bit of comfort in regard to the degree of financial stress we could potentially see out there. What I've also done, I did it last night, was I did a bit of modelling on what household debt service as a percentage of disposable income could look like going forward. Now these are aggregate numbers across the entire economy, so one size does not fit all. But if you go back and have a look at the last time the New Zealand property market really got torched, it was that 2006 to 2008 period, just prior actually to the GFC, when the official cash rate went up to 8.25% and you're seeing borrowing rates up around 10%. Yeah, that saw the debt servicing burden absolutely skyrocket through 12%. Now, the numbers as of last quarter, household debt service as a percentage of disposable income is 5.9%. Yeah, so it's well under half where it was way back the last time we saw a bit of disruption. Now, if I put in what I call a modest rise in rates, that is basically the official cash rate going back to 2%, add about 185 basis points on to the one-year fixed rate from its lows of around 2.19. The longer term rates are up a little bit higher, but basically almost 2% across the entire book, a combination of slower credit growth and income growth around 5%. I get household debt servicing as a percentage to disposable income up slightly in excess of 8. Now, that's up a lot from 5.9, but it's still really low compared to where we've seen it historically. Now, if I put in a different scenario, which has got a sharper rise in rates, which is basically a 300 basis point increase in the weighted average cost of borrowing out there across all households that have got the debt, I get the household debt servicing ratio up slightly above 10. Now, that's starting to get up there. It's not as extreme penny pinching as what it was between 2005, 2008, but it's that trend direction or the sharpness that I think is a little bit more concerning in regard to what it could mean on the other side. Looking more long term, if you go back and have a look at the past 10 odd years, interest rates have been a major driver of property prices. So property prices between 2009 and 2019 increased about 80% across New Zealand. Auckland was up a bit more, but the Reserve Bank used what's called a discounted rents model and basically applied that to home ownership as a substitute to give an idea in regard to, well, how much have interest rates driven property prices up? And the short answer is around 50%. Now, if interest rates are going to move up, you can basically turn that effect back around and put it, suddenly 7% median house price growth, which we've tended to see historically, becomes 3.5%. And maybe something a little bit lower if we start to think about the impact of other various policy initiatives. The one that no one's talking about in regard to property is lower inflation over a long period actually suppressed house prices between 2009 and 2019. And one of the economic effects that I'm starting to think about at the moment is that net effect between interest rates moving up versus inflation moving up on the other side. Now, I think one is going to partially offset the other. I'm pretty confident over the coming few years, real house prices are going to fall. I'm not confident expressing a view that nominal house prices are going to fall. Nominal house prices might ease back a bit, but the real issue here is going to be that real versus nominal story. What's also, I think, quite important out of this is wealth creation in New Zealand has been very property centric for a long time, and it's been driven by lower interest rates. I put an article out on Business Desk yesterday, which is to ask the basic question: what if the housing market's not going to be the main driver of wealth for New Zealand for the next sort of 30 odd years? And there's a real possibility of that. How do we channel money into the real productive economy? Do we have the mechanisms for that. And has that got any credibility? Because what we're seeing at the moment out there at the moment is the business sector is getting absolutely pummeled. Now, some of this is short term, some of this is government policy, but one of the bigger picture secular themes that I'm thinking about at the moment is really simple. Maybe we're overweight property and we're underweight real productive stuff. Yeah, the housing market's 4 times GDP, and the market value of the New Zealand Stock Exchange is around 50% of GDP. Now, this does not mean housing's a bad investment. It just means maybe in a rising interest rate world, it's not going to be the stellar investment that we've been used to. And one of the big issues we'll get out there across New Zealand, particularly at the moment, is that how the hell do businesses get a loan? Yeah, banks are pretty furiously writing housing credit because the risk weights favour that. Yeah, they've cut the guts out of costs, so I don't think their capability in regard to delivering into the business sector is that great. In fact, I think that ability has been greatly diminished over a number of years because they're focused on the short term. They haven't invested in systems. The compliance costs, which is beyond banks' control, is just getting absolutely ridiculous. But they actually don't have people there at the moment that actually understand the foundations of business. And I think there's actually a wonderful opportunity there for people in that space to really help firms be a lot more bankable, or help them pitch what they need to do. So look, just finally wrap things up, stating the obvious, there's still an awful lot of challenges in a Delta world. Hopefully we get out of this thing pretty soon. Unfortunately, there are other scenarios. If you look at the likes of ACT in Australia, yeah, they continue to have 10 odd COVID cases a day. Now that could be a real scenario for New Zealand. And this is where we're going to need to get into that real debate in regard to those trade-offs between health, the economy, and mobility. At the moment, it seems to be one-way traffic in regard to health, as opposed to getting a little bit more balance into the scorecard. I'm focused really strongly on the economic and the social ledger. The more we move on that in a proactive fashion, the less we're going to see silly policy down the track. But it's a real long, slow grind to get housing supply up when some of the big drivers, such as land availability, is real inelastic. Yeah, given that big ramping up we've seen in townhouses, these sort of things over the past 12 to 24 months, that is a pocket of the market over the next 12 to 24 months that I think is going to be vulnerable if that supply-demand shortage flips. The digital economy is obviously on steroids, and inflation, as I said, it's a big wake-up call. It's a mismatch between supply and demand. At the moment, if we don't get the supply up, then demand's got to be the sacrificial pawn on the other side. It's not rocket science. Yeah, let's focus on the building blocks of the economy, which is all about supply. Now, don't focus on the economic recovery. It's about managing an economic expansion. It's fundamentally different discussions or policy initiatives needed. My core view is interest rates moving up about 200 basis points, pretty well across the curve. That basically means interest rates will not quite double in certain areas. I don't find that a scary scenario at the moment if I look at some of the metrics in regard to what that means for the household debt servicing burden. But for some, if you've jumped in the past sort of 12 to 18 months at a one-year fixed rate at 2.19, well, you're going to be in for a bit of a shock, I think, in about 12 months' time when you start to see your interest bill is going to be up in excess of 70%. There's a lot of confusion out there at the moment. And I think there's a great opportunity here for financial advisors to really step up on a whole lot of levels. There's a swath of money out there at the moment that is sitting there in transaction and savings accounts and banks. It is dead money. It is absolutely horrific that there's about $260 billion that is sitting in the banking system as we speak that is getting basically zippo. And that, I think, is a real big personification that there's an awful lot of confusion out there in regard to what would people either like to do or what people can do. Hence, I think there's a big scope, gaps there for financial advisors to really get out there and work with people. And probably going to have 5 or 10 over, but we'll stop right there.
Fantastic, thanks, Cameron. Really great insights there. I like the lower interest rate tailwind is now a headwind. I think it's very relevant. The shocks to the system that you outlined in terms of those percentages and the DTI versus the interest rates as well. I find that really insightful as well. Look, we've got quite a few questions to get through. The first one is, how do we come out of this lockdown? And you may have covered it somewhat, similar to 2020, with a strong bounce back or a more measured bounce.
Right, so if you have a look at, are we going to see a little bit of pent-up demand? The answer is hell yes. If you haven't had a haircut for a month or so, where you're going to be rushing off to the barber, these sort of things, yeah, there's going to be a natural recoil effect. Am I expecting that recoil effect to be as strong as what we saw the last time around? The answer is no. One, I think, yeah, people have played an awful lot of big cards in regard to buying the discretionary items. You don't go out there and buy a new car. Most people don't go out there and buy a new car every 12 months. People had that mad rush to buy a sparkle, these sort of things. Well, odds are you're not going to go buy another sparkle, these sort of things. If you look at one of the reasons we saw a really big bounce back after the first lockdown was the extent of policy stimulus. And a lot of the policy stimulus was delivered really quickly or was delivered in advance. The Reserve Bank did most of this stuff prior to lockdown. The government came out and basically gave businesses 14 weeks worth of money to go pay people. Now, if we look at this time around, has the Reserve Bank done anything? The answer is no. Well, they have. They stopped raising interest rates. If you look at what's being deployed to the wage subsidy scheme or the business resurgence payment, it's basically on a 2-week by 2-week basis. There's not that same amount of money that's getting pumped into New Zealand to sort of bounce us out the other side. And some of that is just reflects the fact that, look, the hope is we can contain this thing now with shorter lockdowns. But also you've got an economy that's in a fundamentally different position. It didn't need that big extreme bazooka that we needed last time around.
Excellent, thanks, Cameron. The other call as well, other question we have is, do you think the government are listening to the right experts in terms of making the decisions between the balance of economic recovery versus protecting the country from COVID?
No, I think the epidemiologists and the health experts are getting too much say in regard to what's going on. And unfortunately, you cannot keep the economy closed or the so-called hermit kingdom without having real social consequences on the other side. Well, I'm hearing anecdotes, and I'm sure people are the same, about, and it's frightening, about regular suicides.
Another question, do you see the government removing their new policy regarding interest deductibility for mortgages on investment properties? If not now, then when do you see those policies, I guess, being retracted?
I'd like to say they will back down on that. My suspicion is the answer is they won't. Does housing have so-called tax advantages that deserve that sort of policy initiative? The answer is no. What housing has got is a leverage advantage. Now, how do you address a leverage advantage? Well, you've got different mechanisms that can tighten the strings on that one. Now, so what we've seen here is just a policy initiative, and it's not just that. There's going to end up being some silliness about it. Trying to work out where the boundaries reside. You build a house, so you're exempt, but what happens if you then sell it to someone? Do they get hooked in the net? And we don't know the answers to a lot of these things at the moment because we're still going through that consultation process. But what we do know is that, look, if you can no longer claim that tax deduction for the property that you've got, then, or if you're looking at buying an existing property to rent out, then the economics of not being able to claim that deduction mean the value of that property in regard to what you will be prepared to pay for that property to attain the right yield is about 15% lower. relative to pre that initiative.
Absolutely. Another question is, given the advisors on the call, it's probably a tough question for you to answer, but we won't hold you to it. But, you know, what would you be advising clients to do in respect to decisions around fixed, and what duration as they make decisions around refixing?
Well, I can't advise, but what I can do is, look, end of last year, I put an article out in Business Desk and I told people I was taking a whole lot of 5-year debt. And early this year, as soon as the banks priced away the good 5-year deals, I started hitting the 3-year stuff. And then they priced away the 3-year stuff. And now, unfortunately, there isn't too much juice left in the equation in regard to pushing things out. Yeah, if you look at through a value proposition in regard to where I think, well, where banks target people, they like people to be, and they tend to be the best value for rates, although they don't provide you an awful lot of certainty. It tends to be around that 1-year rate. Now, yeah, that's not going to suit everybody, but from an outright value in regard to cost proposition, that is the best one in the market at the moment. You'll see the odd bit of ducking and diving, I think, from banks in regard to the odd special here and there. Banks, I think, have been a little bit too quick out of the blocks in regard to lifting interest rates. Now, they're pointing to higher wholesale funding costs. Well, a big part of their book is actually insensitive to wholesale funding costs. All that soggy, cheap money that's sitting in transaction and savings accounts. Yes, I've seen term deposit rates move up. I haven't seen my savings account rate move up.
Yes, I've experienced that myself in the banking industry. So in a rising interest rate environment, will we see the corresponding fight for recruiting talent and wage rises?
Right, so that's really a question about demand and supply. Right, so it's, yeah, why do we need to get interest rates up? Because we've got excess demand. Now, the way to fix that will be to improve the building blocks of your economy, such as supply. If we see the building blocks of supply move up, we're going to dampen a little bit of that excess wage inflation pressure coming from the labour market. The fear I've got at the moment is that people are not focusing on how big those supply side challenges are. And it's a lot more than just getting goods into the item, into the country. And some of these are real structural issues. You go talk to anybody in the nursing industry at the moment in regard to what their skill shortages are, not just now, but for the next 10 years. IT professionals, you name it, we've got deficiencies across the board. And I know there's a massive debate going on, and people have got their own views in regard to, well, when borders open, there's going to be this mad rush of Kiwis, they're going to come home. Well, other parts around the globe have been pretty liberal in regard to they've ditched the elimination strategies. They're learning to live with this thing. They pay more money. I don't think that Kiwi rush home effect is going to be that large. I think there might be an effect out the other side, and that could exacerbate some of the skill shortages we've got.
Yeah, that's true, and it links into another question which you probably potentially answered, which is how do we encourage overseas talent to consider New Zealand as a desirable place to live when they consider the cost of living versus housing versus wages, and as in Australia and other countries that you've alluded to, more preferable to migrate to.
I think New Zealand missed a once in a lifetime opportunity last year to play that card. Yeah, we should have gone out with one hell of a brand proposition to attract 1,000 to 2,000 high-level entrepreneurs, and we're not giving you a visa to buy a house. We don't want your cash. We want your IP. We want you to come down, and you got to employ 10 Kiwis, and you got to pay them above the minimum wage. So not the minimum wage, above the average wage. Now, the time to strike with that was last year. And now I saw there was Paddy Gower on last night, and everybody's looking at there and saying, well, they seem to be having an awful lot of fun in the UK at the pubs. And now we're shut, they're open, and the most important thing was getting the vaccine rates up. And we failed. We're behind. So, but will there still want to be a whole lot of people that potentially want to come to New Zealand, that whole bolt hole thing? The answer is yes. I think we're going to start to see some pretty strong accelerated intra-regional migration things as well. So it's not just about bringing people into the country, it's about potentially shifting people around New Zealand.
Do you think the Labor government is bringing New Zealand to its knees with their policies, as they seem to be creating more problems and inefficiencies than fixing it?
I wouldn't go that far, but what I will say is a couple of things. Look, one, we've been in an era for 30 years where monetary policy, or every time we've had an economic problem, we've turned to monetary policy or the Reserve Bank to fix it through waiving the interest rate wand. We're now in an era of a much more interventionist, bigger, more active government. And there's some legitimate reasons for that, because we let the social ledger get out of whack with the economic ledger, and we shouldn't be afraid to spend money or the government to be involved more directly in some areas of housing. Yeah, but I guess there is right and wrong ways to go about things. There is good policy, there is bad policy, and there is absurd policy. And what we're seeing at the moment is, in my view, and as I said right up front, I think there is too much of a focus on the social ledger. And even then, I don't think the policy initiatives on a whole lot of levels are going to fix a whole lot of those social problems. But it's not just the current government. In all honesty, at the moment, I think the Labor government of the two mainstream political parties has got the stronger team than the other one. And so it's almost, what does the other side sort of look like? Yeah, we need, in an era of bigger, more interventionist government, we need more quality people to be stepping up to get involved in politics. Now, you've got to be mad to want to get involved.
In terms, you mentioned a lot around the supply issues, both in housing and exports and imports, etc. What would you do if you had the ability to help strengthen that supply on the housing side? What do you think some of the initiatives that the government could introduce to try and fix that, in your view?
Well, it's got to be open season on land availability. Yeah, they've opened up, obviously, the townhouse intensification sort of stuff. They're moving really strongly on that front. Yeah, but ultimately, if you look at section sales across New Zealand at the moment in the last 12 months, there's been about 10,000 sections sold. That's not too dissimilar to what was going on in the 1990s. We've got consents running at about 40-odd thousand. Now, a big chunk of that's coming through is actually townhouses, units, these sort of things. But still, we get some sense and sensibility in regard to not just the availability of land, but the cost at the moment in regard to getting it zoned right, and the length of time to go through the processes is just absurd. You're potentially talking lead times for a lot of the stuff of 5 years.
Hey, look, Cameron, I'm just conscious of time. We've got a couple of minutes before we close. If someone's got a last question that they want to send through, yes, actually we do have one. Just to clarify, there are about 2 people per house, so one building consent absorbs 2 people? Question mark, question mark.
If you look at the numbers at the moment, it's around 2.6 people per house. It's tended to oscillate between 2.55 and about 2.7. What's happened in the past 24 months in particular is that the average number of people per house has actually moved up. And it's moved up because housing has got progressively more unaffordable. And as we get on the other side of this, I think you're going to start to see that ratio drop. And it's a function of a whole lot of things in regard to, population aging is one, divorce rates is another, but you tend to see some real different mixes in regard to what's going on. Obviously the number of people per house in a European household is different to what you see within Maori and Pacifica. Massive difference in fertility rates. So you got really different housing needs across different parts of New Zealand.
So Cameron, I'm just conscious that we're on Zoom and it might sign us all out. So I'm going to say a massive thank you to yourself for today. Very insightful. I'm sure people have taken away a lot from this information. And anyone that's on the call who wants to get in touch through Bagrie Economics, I think we've got a newsletter as well that they can sign up to. Would that be correct if they come through your website?
I'm not running a newsletter at the moment because there's more than enough, I think, things that are running around. I'm thinking about running one, but what I am running at 8 o'clock on a Sunday night is a 15-minute Zoom. I started it last Sunday. It's quick, it's punchy, it's what we call straight talking economics. It's 4 to 5 key points. She's pretty brief, but anybody's more than welcome to join that if they just want to flip me an email, and I'll put them on the list. I got absolutely inundated on Sunday. As soon as it sort of disclosed it on Facebook and LinkedIn, suddenly there was 150 emails in my inbox.
Well, the other option is we can send that link out for you if you like to all the attendees on this invitation, if that makes it easier for you, rather than getting an influx.
Of, just send it through because I'll just the time might change occasionally. It's just by flick it. I'm just going to see how it runs. I need to upgrade my Zoom subscription so I can allow more people in the room.
Absolutely. So that's so if you go to bagrieeconomics.co.nz, you'll find Cameron's email address. As he mentions, please feel free to send that to him. Once again, thank you to everyone that's come on the call and listening to what Cameron had to say today. And once again, a massive thanks to Cameron for providing that information. Really appreciate it. Great presentation. Thanks a lot. Have a great day, everyone.